Breakout patterns built reputations. They also broke them. For decades, traders were told the same story. Find the stock making new highs, wait for the base, buy the breakout. Let momentum do the work. It sounded clean, almost mechanical, and for a long time it worked well enough to feel permanent. Most people don't notice when a strategy stops working. Not at first. Losses arrive quietly. Small failures get explained away as execution errors. The market feels choppy, then emotional, then unfair. The real shift only becomes obvious much later, when damage is already done. What's uncomfortable is this. Some of the traders most associated with breakout success were the first to step away from it. Not because they lost discipline, not because they forgot their rules, but because the environment changed in a way the pattern could not survive. Pause for a moment. If a strategy built careers can stop working, what does that say about certainty? This is timeless market lessons, where market wisdom outlives markets. Breakouts are seductive because they align with identity. They reward decisiveness. They feel active. You are buying strength. You are not guessing bottoms. You are participating in momentum that already exists. Psychologically, it feels aligned with how progress should work. At the time, it felt logical. It wasn't. There was a period when breakouts became crowded trades. Too many eyes, too much speed. Liquidity didn't disappear, but patience did. Price moved faster than conviction. Breakouts cleared resistance, then stalled, or worse, reversed sharply. Not once, repeatedly. Here's the part traders struggle to admit. The pattern didn't fail because it was flawed. It failed because everyone knew it. When a strategy becomes consensus, the edge migrates. It doesn't vanish. It moves earlier, or later, or sideways. And those still executing the old rules feel betrayed, even though the market never promised consistency. This is where traders usually get it wrong. They respond by tightening stops, or scanning harder, or trading more. They treat an environmental problem as a personal one. More effort, more screen time, more conviction. None of it addresses the real issue. Let me give you a short story. A trader who had spent years trading clean breakouts started noticing something subtle. Winning trades no longer expanded smoothly. They hesitated. Volume spikes came early, not at confirmation. Pullbacks cut deeper. Stops were hit more often, even when the setup looked perfect. He assumed he was out of sync. He wasn't. The market had shifted into a regime where volatility expanded inside ranges, not outside them. Breakouts still occurred, they just didn't follow through. Silence matters here. The realization wasn't dramatic, it was quiet. He stopped increasing size. Then he stopped taking marginal setups. Eventually, he stopped trading breakouts altogether. Not forever, just until conditions changed again. This is the part that rarely gets discussed publicly. William O'Neill built an entire framework around strength, leadership, and confirmation. But even within that philosophy, there were periods when pure breakout entries carried unacceptable risk. The adaptation wasn't abandoning discipline, it was redefining selection. Most people think great traders succeed by pressing their advantage. In reality, they survive by knowing when not to. Here's a stat few like to confront. In certain market conditions, over half of textbook breakouts fail within days. Not weeks, days. The failure rate isn't random, it clusters. And when it clusters, it's not a trader problem, it's a structural one. You haven't thought about it this way before. Breakouts rely on orderly participation. They need institutions to build positions slowly enough that price has room to expand after confirmation. When institutions are already positioned, breakouts become distribution events instead of accumulation signals. That's the condition most traders miss. They keep trading the pattern because the chart looks familiar, but the participants have changed. Time horizons have shortened. Algorithms respond faster than discretionary traders can adjust. What used to be confirmation becomes a liquidity signal for someone else. Are you making this mistake without realizing it? This creates an identity threat. If your strategy defines you, stepping away feels like failure. Even temporary restraint feels like regression. Traders tie self-worth to activity. The market punishes that attachment insatiably. The professionals who adapted didn't announce it. They didn't rebrand. They just got quieter. Fewer trades, different filters, more patience. Capital preservation became the priority, not participation. This is where philosophy matters more than tactics. Markets move through seasons: expansion, compression, rotation, distribution. No single entry technique dominates all of them. Breakouts are not timeless. Principles are. One of those principles is this: risk is not defined by how good a setup looks. It's defined by how others are positioned around it. When everyone is waiting for the same trigger, that trigger loses meaning. There's a subtle shift that happens in these environments. Selection replaces execution. Traders stop asking, "Is this breaking out?" and start asking, "Who still needs to buy?" That question changes everything. This is not about predicting tops or bottoms. It's about understanding participation. Breakouts fail when demand is exhausted, not when charts are wrong. Most people don't notice this until it's too late. They look back and say the market changed. It did, quietly, gradually, without announcement. And only those willing to question their most trusted pattern felt it early enough to step aside. If this resonates, subscribe. We explore these patterns weekly. The uncomfortable truth is that no strategy deserves loyalty. Not breakouts, not mean reversion, not any framework built in a different era. Loyalty belongs to process, not patterns. Breakouts will work again. They always do. Just not all the time. And knowing the difference is what separates survival from regret. The pattern repeats. Always. The damage doesn't come from one bad trade. It never does. It comes from repetition, from the slow erosion of confidence when the same setup fails again and again. Not catastrophically, just enough to make you question timing, or sizing, or yourself. This is the inner conflict most traders never articulate. On one side, you have rules that built your track record. On the other, you have results that no longer justify those rules. The conflict isn't intellectual, it's emotional. You know something is off, but you don't know where to intervene without breaking your own discipline. So you hesitate. You take fewer trades, but you don't stop. You cut size, but you don't reassess structure. You wait for cleaner breakouts that never quite arrive. Every decision feels provisional, temporary, as if the market will eventually return to what you recognize. This is where risk psychology quietly takes over. Losses in these environments feel personal because they violate expectation, not logic. You did what worked before, you followed the process, and the market responded with indifference. That indifference is harder to process than volatility. Here's a perspective shift. The market isn't punishing you, it's ignoring your signal. That distinction matters. When a signal loses relevance, increasing precision doesn't restore it, it only increases frustration. Traders respond by micromanaging entries, tighter stops, faster exits, more confirmation. Each adjustment feels reasonable. Collectively, they destroy expectancy. There's another story worth telling. A fund manager who specialized in momentum noticed something unsettling. His worst drawdowns weren't during crashes. They were during sideways markets with sharp rotations. Stocks broke out, then stalled. Capital shifted sectors overnight. Leadership changed too fast for confirmation-based entries to hold. He didn't feel fear, he felt confusion. Confusion is more dangerous than fear because it masquerades as analysis. You keep tweaking instead of questioning the premise. Most people don't notice this until it's too late. The quiet self-sabotage begins here. You start trading more setups to compensate for lower hit rates. You justify it as diversification. In reality, you're diluting focus. Risk accumulates invisibly across correlated trades. Losses cluster. Confidence erodes further. Here's a stat that reframes the issue. During certain regimes, average holding periods across professional desks compress by more than 40%. That changes everything. Breakouts depend on time as much as direction. Remove time, and momentum collapses into noise. Are you accounting for that shift? The realization doesn't arrive as an insight, it arrives as relief. Relief comes when you stop trying to force the old framework to work, when you admit the environment no longer rewards what you're offering. That admission isn't weakness, it's clarity. This is where the second transition begins. Instead of asking how to enter, traders begin asking whether an entry is even necessary. They stop reacting to price and start observing structure, volatility, participation, who is trapped, who is patient, who is already positioned. These questions don't produce many trades, they produce restraint. This is where most amateurs fall away. Not because the framework is complex, but because it offers fewer emotional rewards. There's no rush, no confirmation dopamine, just alignment or misalignment. When traders adopt this lens, outcomes change without any promise attached. Drawdowns shrink, trade frequency drops, confidence stabilizes, not because they're smarter, but because they stopped arguing with the environment. This is the realization phase most never reach. They exit the market instead, convinced it's broken. It isn't. It just stopped rewarding what they were offering. The irony is simple. The same discipline that made breakouts work eventually tells you to stop trading them. If this feels familiar, the channel is built for listeners like you. Consider subscribing. From here, the question is no longer whether breakouts will work again. They will. The question is whether you'll recognize the conditions when they deserve your capital. That's a different skill entirely. Application doesn't arrive as a checklist. It shows up as subtraction. When traders step away from breakout-heavy execution, their days change first, not their charts. Mornings get quieter. Fewer scans, fewer alerts. The goal is no longer to catch movement, but to understand whether movement is worth catching at all. This is where daily execution becomes less reactive and more deliberate. Instead of asking what is moving, they ask what is stable, what is being ignored, what is compressing without urgency. They read fewer symbols and spend more time with context. Overnight action, volatility measures, sector behavior relative to index movement. The preparation shifts from hunting to filtering. That change alone eliminates most bad trades. A typical morning no longer starts with anticipation, it starts with assessment. If volatility is elevated and leadership is rotating aggressively, activity drops. If ranges are expanding without follow-through, size stays small or stays at zero. Cash is not idle here, it's intentional. This is where amateurs and professionals diverge quietly. Amateurs feel pressure to act every day. Professionals feel pressure to preserve clarity. One seeks opportunity, the other avoids misalignment. Neither announces it. The difference shows up only in drawdown curves. Here is a practical contrast. In breakout regimes, execution is front-loaded. You prepare to act quickly. In non-breakout regimes, execution is backloaded. You wait for confirmation that patience is still being rewarded. If it isn't, you stand down. Most people don't notice how hard that is. Standing down feels like missing out, but missing out is cheaper than being wrong repeatedly. Over time, traders who adapt notice something subtle. Their emotional bandwidth returns. Decision fatigue drops. Losses stop clustering. They don't feel smarter, they feel calmer. Ignoring this lesson has consequences that don't announce themselves. Overtrading becomes normalized. Small losses become routine. Traders accept constant friction as the cost of participation. Eventually, they stop trusting their own read of conditions because they never gave themselves space to observe them cleanly. This is not burnout, it's misalignment. When execution ignores environment, stress accumulates silently. Sleep quality drops. Screen time increases. Relationships absorb the spillover. None of it feels dramatic enough to address until it becomes unavoidable. Adaptation is not about finding a better entry. It's about protecting attention. When attention is fragmented by constant low-quality signals, learning stalls. Traders stop improving because they're too busy managing noise. This is where learning re-enters the picture. The traders who survived multiple cycles didn't evolve by adding tools. They evolved by removing assumptions. They studied their own periods of inactivity as closely as their best runs. They asked why restraint worked, not just when. William O'Neill's deeper legacy isn't a set of patterns, it's an insistence on alignment. When the market rewarded momentum, momentum was pressed. When it didn't, exposure was reduced without apology. There was no moral attachment to activity. That mindset ages well. Over time, traders who internalize this stop measuring success by trades taken. They measure it by mistakes avoided, by weeks where nothing happened and nothing was lost. That sounds unremarkable. It's not. Most never reach that point because it offers no external validation. There's no chart screenshot for patience, no applause for sitting out, just a quiet continuity that compounds slowly. Financially, yes, but more importantly, psychologically. Lifestyle balance enters here not as a goal, but as a byproduct. When execution aligns with environment, stress becomes proportional instead of chronic. Traders leave screens earlier. Mornings feel less urgent. Even losing periods feel contained because risk was respected before the trade, not managed after it failed. This doesn't mean certainty returns. It never does. What returns is trust, not in a pattern, but in your ability to step back when conditions don't justify engagement. That trust becomes the real edge over time. The resolution here isn't clean. Breakouts will tempt you again. They should. When participation resets and accumulation becomes visible, they deserve attention. The mistake is assuming permanence. The lesson is remembering impermanence. Markets don't reward loyalty, they reward alignment. The traders who last are not the most aggressive or the most disciplined in a narrow sense. They are the most willing to disengage when their best tool stops fitting the moment. That willingness doesn't feel heroic, it feels quiet, almost boring. And that's usually how survival looks.